All right. Hi, everybody. Kevin Wadsworth with me, Patrick Karim, and our super duper guest for the first time. You guys might know him as Manico64. Mario, he invited us like a little while back there to be on the show. And I just thought it'd be a good idea to get his thoughts on like the whole state of affairs. And for those that aren't following Mario, he has a great YouTube channel. So I don't know, Mario, if do you want to introduce a little bit people so you could tell people could start looking up your stuff before we
Sure.
get going?
Yeah, thank you for having me on. My channel is Maneko64 on YouTube. I'm also on Twitter. Those are the two places where I'm most active. And I've been covering the economy, the markets, precious metals, geopolitics ever since late 2015. My background is as a bond futures and options broker in the city of London. And yeah, uh, I've been trying to warn people about inflation ever since 2002, actually, when Ben Bernanke made his famous helicopter speech. And I knew then that we're going to have this kind of crazy monetary policy. And yes, that's where we are right now, I would say, and that's why I think it's more important than ever to have some precious metals, physical gold and silver. The other miners and stocks and things like that, that's a little different. That's more speculative as well. But I also think that we're seeing a change from the paper assets, stocks and bonds, into hard assets, and it's going to be I think hard assets will outperform paper assets for many years to come, even though we go through ups and downs.
Man, it's super interesting you said that about the 2002, because if you don't mind, I'll share my screen just to show you, because as soon as you said that, I asked it like a trick question on Twitter. I asked the people, what was the highest valuation ever for US equities, but I said real valuation. And then it tricked a lot of people because yeah, I have this chart here, but look, yeah, okay, I'll show this one. And this is 2000, and this is the SPX measured in gold, and the highest valuations ever. Like what we have today, even if nominally the SPX is super high, gold has maintained. But the biggest of the peaks, honestly, in the disconnect between SPX and gold, or like real value, was the dot-com bubble there. We've never seen something that disconnected.
Yeah, and the Dow gold ratio at the time was above 40 as well.
DGI, Dow to gold. Yeah, so yeah, that was probably the best time to get in, to get long gold for sure there. Oh, Jesus. You don't want to see all those drawings. Yeah, look at that. Look at this peak here. Yeah, 42, 45 to 1.
Yeah. I mean, the FTSE 100 index here in the UK, it's still at the same level it was in 99 nominally, around the 7,000. So we've even, the FTSE has lost even more value versus gold, because the ounce of gold back then was around under 200 ounces, 200 pounds an ounce, and now it's like 1,500. At least the Dow and the S&P have done nominally well, but yeah, we've been in a bear market in real value since 2000. I would say if you go back to 1930, well, 29 and 33, before 33, the Dow was measured in gold because the dollar was as good as gold. So yeah, people forget that.
Look at that. It's huge. Even here in the
yeah, that was a 1929 top.
Yeah, 1929. 1960, a lot of people forget this. I think it was like the Nifty 50 or whatever. Like it had
I think that was the top in that ratio. Yeah.
So my question for you is: do you think this move here? Do you think this is gonna climb up, or you think this is it? And
Mm. You see that one in the 60s, they try to pump it back up, you see there, and then they failed. They've been trying to pump it up since '08, you know, the paper market. But I think, to me, that looks like a pretty big head and shoulder now, you know, in the ratio. And I would say we will see one or even less eventually in that ratio. I don't know at what price.
down, yeah, I agree. It's because even nominally, people are going to see the Dow. Let's say it goes even to 40,000, but if that ratio is 1-to-1, that
Yeah.
means you've been losing ground, right?
Yeah, and there's like if this Dow Gold ratio chart is, you can draw a megaphone on it, can't you? And you know, with the highs and the lows, and megaphones are usually interesting formations. But this one, of course, has been dragging on for many decades.
Look, it's weird, Kevin, because I know it fits on log, but it's also you could still draw something on linear for that ratio.
Yeah.
Look at that. Is that the megaphone? Something like that, maybe?
Yeah, that's kind of like that. But it looks like the reason why, you know, if they hadn't come out with QE in '08, '09 and the bailouts, I think we would have been down to
Yeah.
0 and 1 way before, and we'd actually probably be recovering now and doing a lot better. But you know, they wanted to keep a defunct and dishonest monetary and banking system going. So that's how they've done it. You know, I think central bank balance sheets were under 3 trillion before the '08 crisis. Now they're above 30 trillion. So they've created 30 trillion just to get the Dow to go up like this versus gold. Because once this turns down sharply, I think you know, it could be very quick.
Problem is
right?
to do that, of course, incredible amounts of you know, money printing, if you want to call it that, has taken place, and a lot of debt creation in terms of nominal growth of that debt. I think in the US it's somewhere around 30 trillion, is it now? That's not counting unfunded liabilities, but that does limit to an extent what the Fed can do in terms of interest rates, because of course you raise rates, you're raising yields, and yields go up, and if the nominal number is too large, then you're going to have problems repaying your, you know, meeting your debt obligations. So, you know, maybe what they've done since 2008 to now has, you know, kind of put things off, but it's quite possibly made things worse in the process. So, you know, you can kind of look at a chart like this and just get the sense that what should have happened, you know, a cleansing of the system, if you want to call it that, has not been allowed to happen. So all we've probably achieved is, you know, storing up a bigger beast,
Yeah,
you know, for the future.
it reminds me of Japan, because you know, they killed over, the bubble there burst in 1989, 1990, and they've been trying to keep it going ever since. But the Nikkei has never gone back to about 40,000. And this is the same thing. You know, the Dow, you could argue, has never gone back to 40, above 40 versus gold. And yeah.
It's amazing when you tell people, you know, by the way, did you realize that gold has outperformed the stock market for the last 22 years? People sort of look at you in disbelief, as though you're kind of, you know, you get accused of cherry picking your timelines and so on. But when you look at Dow to SPX over the last 100 years, it's been a fair, sorry, not the Dow to SPX, the gold to SPX ratio over the last 100 years. It's actually been a relatively kind of even battle, with a kind of expanding sort of wedge pattern, which you know, for long periods of time, gold has done very, very well indeed. But certainly the last 20 years, yeah, gold has outperformed SPX overall. So, you know, it's strange the way people kind of view things sometimes. If you don't have a chart in front of you, you're kind of just going on a narrative that you kind of pick up on media and social media. But, you know, you need to focus on the facts, really, and the chart does that for you.
Yeah, I mean, the mainstream financial press, you know, mainstream economists, they totally ignore gold, and they don't want people to look at these things. So the other thing that you mentioned about all the debt, you know, the almost 31 trillion now in the national debt, all the corporate debt as well, unfunded liabilities, it's huge now. It's even bigger than in 08. And you've got Powell today. He was testifying, I think, in the Senate. I saw some of the headlines. He said that they should be able to fight inflation and not have a really bad economic situation. He said
Wow.
the U.S. economy is quite strong, even though I saw some headlines saying that he said that the chances of a hard landing could be increasing, but they never mentioned the debt, you know, and it's almost like they're trying to hide the debt, you know, but that's the big 500-pound gorilla in the China shop, and I think we're close to an accident here, because when the Fed tries to reverse policy, they always have an accident, and especially now that everything is so leveraged. You know, what they did in March 2020 was like really huge compared to 08, 09, and I suspect the next time they have to inflate again, it's going to be even bigger. And one reason I say that is because I've studied a bit, you know, about history and how, for example, in the 1790s France, during revolutionary France, they issued the assignats, but they were very reluctant to issue the first tranche of assignats. And they said, well, we're only going to do it once, and when everything's okay, we're going to withdraw all this paper money from circulation, and then you get a boost to the economy, but then the economy goes down again, and you keep doing it. There was the currency collapsed, and they burnt the printing presses in the main square in Paris. So I see a lot more QE going forward, I think.
Yeah, and that's what I think. That's what, look, the gold chart tells you. Like I just highlighted, every time the gold to SPX ratio is reset to these low points. But look at gold, the price here, it was $35. But look at the ratio fully reset. But gold didn't go back to $35. It stayed at around 300. Right here, this ratio line around 300. Here in 2007, we retouched that ratio line, but gold was all the way up to 600. We retouched a ratio in 2018, but gold's 1150. Now we retouched the ratio. So for me, that's showing me that they need to keep printing. Gold's showing the printing, but they're not getting the same squeeze out of that printing every single time to nominally or real adjusted SPX. It's like every dollar they print is just not enough to keep it afloat.
Well, you can see that, Pat, on your DXY adjusted for PPI, which is using PPI as a proxy. The US dollar inflation adjusted. We're all used to looking at the US dollar index chart, but when you factor in inflation, it looks rather different, and it's a decaying chart, really. Each time you get this round of sort of financial injections into the system, there's a small reaction, but each time it sinks lower and lower and lower.
Yeah.
So there you go. You got the black chart there is the US dollar index, but if you actually, what the chart I was thinking of actually was the US dollar index adjusted for inflation, DXY.
It's right there. It's
is that what you've got there?
One.
Right, great. Yeah, that's the orange one. So you can see the orange one effectively starts at the top left-hand corner, and it ends up at the bottom right-hand corner, which is just a continual decay. Each lower peak, and a bit like, I mean, the DXY chart itself is showing lower highs to a large extent. This latest run up is getting a little closer to the previous high, but yeah, when you adjust for inflation, of course, it's the complete opposite. It's going the opposite direction. And the way to think about that is that, and people have said this is crazy, how can you inflation adjust an index? If you think about it, the US dollar index is the US dollar versus the euro principally. So if you adjust that number, the dollar index number for inflation, then what that's telling you is that throughout the period from the left to the right there, that DXY number has varied from about 160 down to about 60 or so. But as inflation continually eats away at that index, both the euro and the US dollar are sort of in sync, handing the baton from one to another, but both going down. So that the whole ratio is going down. The whole index is going down. You can compare them to each other as much as you like, but when you can compare that number, the US dollar index number, to inflation over time, it just sinks. I mean, the DXY would need to be somewhere, I don't know, north of probably 300 for it to be going sideways in relation to inflation.
Yeah, I mean, the dollar index, one of the reasons they created it, I think it was March 1973, was that after Nixon closed the gold window in August of 71, they kept all the major currencies pegged against the dollar. But and then they realized that without a gold-backed system, you couldn't peg currencies because countries started to cheat, to print. And then they had to just let the currencies float. So we got this floating rate exchange system. And the dollar index was created in March 73, just so people could have an idea of how badly these fiat currencies were floating against the dollar. And they started it at 100, and the euro wasn't around. So it's actually the Deutschmark, French franc, Dutch guilder, Italian lira. So, in almost 50 years, it's gone from 100 to where are we now? I don't know, 104. So that's up 4% in 50 years, while gold at the time, I think in 1973, was trading around $80 an ounce. So, I mean, you tell me what's the best currency to have.
Just from that previous chart that you had there, Pat, actually, noticed the divergence between the two charts, the US dollar index and inflation adjusted. Is it just me, or is that the first time in the entire chart
Kevin,
that we had that amount of divergence?
When you were talking, my eyes were scanning. I said, when the hell did this happen where the US dollar is showing so much strength against the euro and the other ones, but inflation adjusted, it's sucking wind so much. Like, Mario, who's lying here? Is it somebody's lying here? What, who's going to win? Look at that. It's crazy, right? What's happened previously, it's
back the 60s. I think they just extrapolated it back. But it did start in March 1973.
Yeah, well, I marked it here, 73, and you're right. We're at the same level. The DXY nominally is at the same level it was when March 73, Mario. It's crazy.
Pretty much, yeah.
It's crazy.
So
but that's why the inflation. Yeah.
Right, so all that's telling you really is that in relation to each other, the US dollar and the euro haven't gone anywhere. In their relative comparative strength, the US dollar versus, well, Deutschmark as was, euro, and others, British pound, Japanese yen, a couple of others now, that basket of currencies that the dollar is compared to, the dollar hasn't lost or gained anything over that entire period. But one thing that has happened over that entire period is that they have all lost a huge amount to inflation. Just think what $1 could buy you in 1973 and what $1 buys now. How much did a house cost in 1973 and what does a house cost now? So, it kind of reminds you that it's all relative. It's all very well comparing the US dollar to the euro, but it doesn't tell half the story.
I think it goes to show as well that these major central banks, they're all managing things together. I know sometimes it gets out of hand, like it did in '85, but they're all trying to coordinate policy, the major central banks. And I've even thought, if there is some kind of reset, that maybe they will have the dollar index at 100, because in their view that would be a fair thing, because it would be the end of the floating rate system if they do a reset. And then that, you know, they'll have to go back to where it started, which was 100. I don't know. Maybe I'm reading too much into it, but
in terms of what's happening in relation to history and historical precedent, there are a few charts that have jumped out at me over the last few months. One is the German PPI. Of course, Germany is the powerhouse for the European Union and for the Eurozone. And when you look at German PPI, if Pat can call that up there, the German PPI is at a level that we haven't seen at all since, well, the chart goes back to sort of the Second World War. And if you sort of scroll back on the chart there, Pat, to include the 1940s and the 1970s.
The 1950s even.
Oh, I was thinking of the year on year.
But I'm going to put it for you, the year. It's easy. I'll just do it here.
Okay.
There you go.
Okay, so there you go. So you can see in just after the Second World War, that peak in around about 1950, 51, the PPI was somewhere near a reading of, what was it, 20 or something like that at the peak. In the 1970s, it reached, I don't know, visually, it looks like something around just below 15.
Yeah.
And where we are now is heading off the top of the chart. And I just, you know, that's
go back to Weimar Germany.
Well, it makes you think that something is happening that's of truly historic proportions, and this isn't just a normal economic cycle. The other chart, of course, is the 10-year yield, the US 10-year bond yields, and you can do the same with the 20 yield and 30-year yield. But the 10-year yield, which has broken out of a very long resistance line, and Pat will draw it on the chart for us there. But I sort of, you've probably seen on my Twitter feed there, I've been referring to it as the pain line, and this demonstrates quite clearly what you were talking about. So what we've got here is a resistance line that goes back to the 1980s, and you can see initially pre-1980s we had a support line that was taking the 10-year yields up. Then we switched in the 1980s to a situation where instead of having a support line leading the chart up, we had a resistance line, which Pat just put on the chart there, that's leading the chart down. Now we've changed again to a breakout and what looks like a developing situation where this is going to be a support line taking the chart up again, some kind of channel maybe. Although of course in the 1960s and 70s there, whatever channel there might have been, it just blew straight through it. So there's something going on here that is maybe analogous to the 1970s, certainly not anything like what we've seen in the last 50 years there, 40 years. So what do you make of that as well?
Yeah, I mean, up until a couple of weeks ago, not just
are we losing?
I think your camera's frozen there, Mario. I don't know if you can hear us at all. Camera. Oh, you're back again. You're back again.
No, sorry. Yeah, as I was saying, up until a couple of weeks ago, Treasury yields, Italian bond yields, UK yields, all the major yields were going up rapidly, and I think there was a problem there. And then the ECB called this emergency meeting and said, "Oh, we're going to do everything it takes to stop this fragmentation," they call it. And then the yields came down, and I think now as well, the 10-year yield has dropped quite a bit in the last 2 weeks. It's even down 15 basis points right now. But I think what we could see, and I think what the bond market might be saying, is that we're going to go into a recession and yields are going to drop a bit. But I think if they drop, they'll retest that trend line there, and then they'll just zoom right back up. I've looked into this, and there seems to be a 40-year cycle in bond yields. There's a low in late 41, just before Pearl Harbor, I think below 2% in the 10-year, and from 41 to 81, yields went up, and they topped in 81 just below 16%. So if you do, 81 plus 40, that's 2021. I mean, the bottom was we had a bottom at 0.3, I think, in was it March 2020? Last year we had a pretty low bottom as well. So yeah, I think we could be turning. We could be having decades of higher yields,
which is going to cause problems. I mean, I'm not an economist, and that resistance line that has led us down from the 1980s to now was there for a very good reason. As I say, I'm not an economist, but to me, the reason is if you were to overlay on this chart the US government debt, it goes something like 10 trillion, 15 trillion, 20 trillion, 25 trillion, 30 trillion from left to right.
Yeah.
And that has an effect on obviously what is possible in terms of yields, I would imagine. It's probably fairly simple mathematics. There you go. There's the debt going in the opposite direction. So it makes perfect sense that as the debt rises beyond a certain point, that mathematically it's only plausible for rates to be at a particular level. And it seems to me that that chart was telling us what that particular level was at this point in time. It's somewhere below 3%. You push above 3%, and I called it the pain line because something painful is going to happen, in the global economy and particularly the United States. So, that pain that we're feeling now, it's probably no coincidence that the S&P has started to fall quite rapidly, and that we've seen 70 to 95% taken off the cryptocurrencies, which are really just tech stocks at the end of the day, so it would appear. So, put in that context, precious metals pullback and gold pulling back a few percent is nothing. And even if gold fell another couple $100, it would still be nothing given the magnitude of what's happening. And it would, to me, I don't know if you agree, Mario, likely, set us up for a huge precious metals bull run.
Yeah, I think this 40-year cycle, it helped grow the debt from under $1 trillion in 1981. I think it was just under $1 trillion when Reagan took office, all the way to 31. And now it's going to be the opposite. It's going to be payback time. And I think there's so much fake wealth or fake value out there. And even if a small percentage of that flows into hard assets and precious metals, it's going to create a huge, it's already creating a huge bull market in commodities. And I think the jury is still out on whether they can control this new trend in yields, that they can keep things going for the next 40 years gradually, or if they're going to lose complete control and we could see, what we saw in Greece and Italy and the other pigs countries in 2012 happen to the whole world, because then all bets are off. You could see a complete collapse. You could see US Treasury yields at 20, 30, 40%. People might laugh about that, but the Greek yields were really low prior to 2011, 2012, and they went to 40%. And Italian yields didn't go higher than 7.5 because Draghi came out and promised to throw everything at it. So yeah, it's all very, very, very interesting, and that's why I'm comfortable staying outside the system as much as possible with hard assets.
You're so right, Mario. Look at this. While you guys, I was talking, so here, this is what's tricky, guys, because often you see lines like this, M2 money supply, total public debt, they just go from top left. But what the market's reacting to are changes in acceleration or deceleration, which the market prices in the rate of change. I put the 7-year rate of change for the total public debt. And look at that. Every time there was an explosion, even if it's flat here, every time there was an explosion, the US equity, the commodities we know, like the 70s, went up, right? Look at that 2000 when we started getting an explosion in rate of change. Even if it was nominally much higher than before, we got a boost. You see when it topped off the rate of change, and look, it's just broken out again, guys. Just broken out again. It's like
interesting. Yeah.
So there's another acceleration in total public debt that has to be, like I like to say, gold prices in the required monetary imbalances to keep the whole system afloat. And
yeah,
so
I think Jim Sinclair, he wrote a book about 10, 12 years ago called A Pocketbook of Gold. And it was, it had another part of the title said it was how to navigate through monetary mayhem. And he said what gold does, the gold price, is reveal real wealth. You know, it's a revealer of real wealth. So yeah, because this public debt going up and all the high value tech stocks and everything, that's all like funny money.
Another chart that kind of demonstrates the what we're saying here is that it's the 30-year divided by the 10-year yield. That's another one, Pat, as well, that kind of picks up this sort of these rotations that are taking place. These big picture macro charts reveal what is happening with monetary supply, where the money's going, and you can look back in history and see how things like the 30-year divided by the 10-year yield, and particularly the ratios as well, ratio charts, pick up these, well, what paradigm shifts is probably the best phrase for it. You know, these sort of kind of shifts that take place once in a lifetime.
Yeah, look at this. This one, Kevin, we're back at the 30-year. Hold on, I just want to make sure I got this right. The 30-year yield divided by the 10-year yield, the ratio is back here. It did a full reset.
And look at the points in the past where it hit that level, where it was. You know, 2018 there was a low point in gold. 2000 and Pat's just putting those on there.
Yeah,
all these points here are just prior to big upswings for the gold price. And Pat might put the gold chart on there and overlay it for us. You can see exactly what the gold price did at those points. On all of those occasions, gold moved to the upside.
I never looked at that ratio, the 30-year versus the 10-year. That's interesting.
Yeah, well, it's fun, Mario, because you might have like the historical or fundamental hindsight to make sense of this. Sometimes, you know, I just put up charts and I check out ratios and I see how other instruments, but I don't always understand, like, okay, that's cool, but
yeah, I mean, the chart shows you like the last time we were down here, like you just put that arrow there, that was in 2018, and then gold started taking off.
Yeah. Well, look, that's what I'm expecting here. So the way I see it, I see that ratio as a fuel reservoir. So every time it expands, fuels like gold is consuming that fuel, but when it gets too stretched, it reverts back to its starting point. But what's very bullish about this, it's the hidden bullish divergence. So while gold is doing higher highs, and the ratio is doing lower lows, it's very bullish because you did a full reset in that ratio, but gold did not go back to its 1100, right? It's staying perched at 1800.
Yeah.
It's like, yeah. It's like skewed. Everything's skewed upwards. They're like just adding zeros to everything. Yes, price goes up and down, but over like since 1970, like practically all instruments, right? If they haven't gone bankrupt, they're just keeping adding zeros over and over again.
Yeah, it's just the debt is keeping everything going.
All right. So what about the deflation scenario, Mario? And I mean like real deflation for a sustained period of time where they're not able to create inflation. Is that even possible?
Well, I mean, that would, for me, deflation would be them allowing the money supply to actually drop, you know. And if you look at M2 historically, you know, there are little blips where they drop, but it doesn't last very long.
I suppose we're talking about disinflation, I suppose, rather than deflation, which is where the whole stagflation terminology comes in. Because if we're at 8 or 9% inflation and it comes down to 4%, that's not.
You still have inflation there. I mean, you have rising CPI,
Yeah.
But, you know, in the 30s, you had real deflation, which is a drop in the money supply.
Yeah.
I need a longer term
I don't know
M2.
that back as far back as
I know which one. Currency and circulation. Look at that. Look at that beast. Whoa, we have everything.
Oh, that's a good one. 19.
Yeah. So here the 7-year rate of change, Mario, for the currency and circulation was negative. So yes, that means if the 7 year, if you bought 7 years ago, right here, the money supply was actually vanishing right here in these periods.
Years, I can't see the year there.
I'll put markers. Sorry, I'll put these ones like 1927. There was a 7-year 1930. I'll zoom in there just to make it a.
So what I'm saying is, I only see deflation if politicians and central bankers become gold bugs, and they don't want to be statists anymore, you know, and they don't want to have a welfare state in the military industrial complex. So, you know, they tell us that Japan has been in the deflation, but you look at and you know, it might be in a stagnant monetary economic how can I say environment, but you look at the price of gold in yen, it's gone from about 50,000 to about 250,000. So they are debasing the currency. When you debase the currency like that, that's inflation. So everything's kind of screwed up, all the definitions. So yeah, I guess people will call it deflation if we get the stock market crashing and we get a recession. They'll say that's a deflation, but then, you know, commodities will keep going up, because I think commodities were the best performing asset in the 30s during the deflation then. So there you go.
Well, this is curious because indeed Japan hit a peak in inflation in 1980, and the yen appreciated versus gold violently. That's disinflation, actually, right? That's the purchasing power of the Japanese people has actually been going up during this. But since 2000, I don't know if that's when they started the money printing like crazy, but now they've totally reversed the move.
Yeah, and I think disinflation, I think what doesn't help gold and commodities is the Goldilocks scenario, where they can keep things moving quite nicely. And when they still don't have that much debt, you know, you've got like 30 to 60% of GDP in debt, and you can keep interest rates between, you know, 2 and 4%, maybe a bit more, and the economy is growing. But right now we don't have Goldilocks. So
no, I think debt to GDP is what, 130% in the United States, is it? Is that right, I think?
Yeah, and the thing is, if you look at the formula for calculating GDP, it includes government spending. So if you look at the private GDP, I would say, if you could look into that, you can't. I don't think they do it, but I would say the debt to GDP is a lot more than 130%. You know, because they're
it's 236,
isn't it? Yeah.
Private debt to GDP,
235%. Wow.
Wow. That seems a bit unsustainable somehow.
Yeah,
it's crazy. I've never looked at that chart.
I mean, you know, as a scientist, you look for tipping points, because, you know, a balanced equation is great, but if stuff starts to get out of whack, then very often you get a kind of runaway effect that takes place until you hit some kind of buffer that reverses the entire move. You know, things you can kind of you know, get away from you very, very easily, and if there's nothing to stop it, then it kind of ends up in a bit of a collapse, a bit like the greenhouse effect. You know, look at what the greenhouse effect did to Mars, which once had a very sustainable atmosphere, had a very overheated greenhouse effect, and you now have a barren rock. Well, you could probably liken the economy to that. You know, if things get out of hand and snowball, then the entire economy turns into a barren rock.
Yeah, I think it's dangerous because the people in charge, the Keynesians, really, they're all like PhD economists, and they advise governments and other people, and they think like everything's always going up, and that there's no end to things. That there are no cycles. There are blips. Yeah, I think it's really dangerous. Unlike the Austrian school, where they look at human action, what could happen. And that's why I think a lot of people are going to be shocked in the next few years. They're already shocked now. They thought this inflation was transitory, and it isn't. I saw that Powell today said that the inflation could still get worse. And here we are, a year after he said it was transitory.
Well, these are the guys who didn't see it coming. It was interesting talking to David Murrin a few days ago, who was talking about that very thing, where you have lateral thinkers and linear thinkers, and people get into this mindset that okay, things have been this way for the last 40 years. That's the way it's going to chug along, and without kind of zooming out and thinking laterally and actually considering the weight of evidence that me and Pat keep talking about. I'm sure if myself and Pat and you and others were able to sit down and see this coming, either they didn't see it coming and they're incredibly stupid, or they saw it coming and took us as being fools and kind of sold us this. When I say us, I mean the public. This line about inflation being transitory and don't worry, it's not going to be a problem. And here we are, as you say, in the UK, sitting at whatever it is, 9% inflation and rising, heading towards double-digit inflation this year, almost certainly.
Well, I saw the RPI in the UK, which is, I think, a better measure, was 11.7. I also saw in Canada today you had 7.7 CPI.
Yeah, and of course, if you you measure things the way they were measured 10, 20, 30 years ago, then you come out with an even higher set of figures. I think Shadow Stats is a website that does exactly that. And if you continue measuring stuff the way it had been measured previously, you're probably talking about 15-16% now.
Check. If you want a trick, Mario, look at the producer price index. So it's all commodities. I think it's like even other costs incurred by the producers, and there's no hedonics on this. So if you want the truth of inflation, check out the producer price index. And I've put the 7-year rate of change. So even if they went from top left, you see the producer price index went down here. This is the deflation you're talking about in the 30s. Yeah. But even if it's been going up, this is a 7-year rate of change. And if people think we've topped out, look, we've had much more stronger explosions in rate of change. Like here's the 1980 peak, here's the 1948 peak. We're just like breaking out above these historical pivot lines. So yes, it could pull back, but history has shown us that these moves are violent, and they could keep accelerating higher. Like until we reach this line, I wouldn't take profits of any of my metals.
That's an interesting thing. People usually don't look at rate of change, but I think you're right. It's very important.
And look, yeah, all these.
The rate of change there is effectively telling you how much fuel is left in the tank, if the situation, is right.
Go up 2.5 times. I mean, 40 times 2.5, 100.
Yeah. So and
yeah, I mean, you could see the PPI there going up to, I don't know, 500, 600, 700 by the time this hits the top line.
Look, yeah, and all these bullish crosses above its 7-year EMA there, moving average above the zero line. Look, this I overlaid silver, and you see even silver tracks the inflation very well. There's peaks and there's drawdowns, but overall that line, it fits pretty much. But look at these signals. Once you get them, there's no when it's inclining, there's practically no false signals there in this. Look, Jesus, man, what do you think?
One thing that you can notice from that fairly quickly is that the rate of ascent in the rate of change recently, in the last year or so, that the angle of ascent is very, very steep. Historically speaking, there are periods like the 1940s there where it was equally as steep, but this is a major move that's taking place at the moment. We've got an angle there. I'd hazard a guess that it's well over 70 degrees. Looks more like
I saw today,
Whoa, 80.
Yeah.
we had a PPI today in the UK. So they published the input PPI that came out at 22.1% year on year, and the output PPI came out at 15.7. So
And the thing to bear in mind with that, of course, is
Output.
that if it's a blip and if it was transitory, then the producer prices can be contained without being passed forwards into the consumer prices and therefore inflation. But the longer producer prices remain elevated, the more those input costs must be passed on to the consumer eventually. So this is another way of thinking, of the fact that this is storing up inflation for the future.
and what's also now caused, probably I think will cause a lot more supply chain disruptions. We had the COVID and everything, shipping and worldwide trade, but now we're starting to see domestic workers like strike. Like in the UK, we've got rail strikes, tube strikes, and we even have barristers striking. So that could disrupt everything. That could make the PPI go up even more.
Well, I think this is presumably what the bankers, the financiers, the Fed, and everyone else is scared of, because you start then getting into an inflation that's being pushed not just by increasing input costs, but by increasing wage costs. And bearing in mind that inflation has been, I don't know, 3-4% for quite a while, and government workers in the UK have had almost no pay rise for many years. When you look back, we're already kind of behind the curve in terms of trying to keep up with inflation for public sector workers. Private sector's done much better, but of course huge numbers of public sector workers in the UK. And when you see numbers like 9% inflation, everybody's aware of it. It's all over the news stories, so that there's no escaping this now. And
I saw Merseyside Rail, they got a rise of 7.1%. So that's going to get the ball rolling, and even at 7.1, they're losing out, because if CPI is at 9.1,
yeah, and rising, yeah. Wowzers! It's a pretty incredible situation that we've got ourselves into, and it's pretty unforgivable, really, for the guys that are in charge of all of this. The central banks, the Federal Reserve, the economists. It's just something that was really avoidable in many ways, and coming off the gold standard and not having sound money or any way of controlling the increase in money supply really only leads in one direction. And David Murray was talking about this, of course. It's a sort of an end of empire kind of thing. It only ever ends one way. Fiat currencies are, by their very nature, unless pegged to something hard and tangible, then doomed to collapse and failure. And the question, I suppose, is whether that process takes place peacefully, with a peaceful transition, or whether what's coming over the next 10 years is much more violent. And we've seen these huge tumultuous periods in the past, and I think modern society despite all our technology and ability to actually look at the past and see it in charts and watch it in movies and all the rest of it, people just seem to assume that there's no way that's going to happen, everything's fine. It's incredible, that kind of linear thinking.
Yeah, you said the point that they didn't go back to a gold standard, and I think it's been a push to try to say, oh, we can do it better than the gold standard, but now we've had so many mistakes, it's all been accumulated. And I think a lot of people in this, the economists and the advisors, they're so much into this paradigm, they can't see, they're in the forest, they can just see trees. They don't know that there is something else out there. And when we try to warn people and tell people, very few want to listen to it. But eventually people, and they're going to ask questions, and when it will happen, I don't know, but I think we're very close.
I thought about that, and often people, why don't they go on the gold standard, them? But honestly, tell me if this is wrong. Why don't I could have my own gold standard?
Yeah, that's right.
What's wrong with that? I have gold. I don't care what you do, because my
that's
gold's gonna.
But what I mean is more for society in general.
Yes.
I did a video, I think it was yesterday, that the unions in the UK, the trade unions, they should look at gold, because if in 2002 they said, "Oh, we want to be paid in gold sovereigns," like 34 sovereigns at the time would be the equivalent of £2,000 a month. And if they got that deal, they'd still be getting 34 sovereigns today. That would be almost £13,000 a month salary.
And that is actually possible now,
really,
Mario. There are companies and organizations that do that, and it is increasingly possible to be digitally paid in gold that is allocated.
Yeah, but you need to fix not the price, the fiat currency salary. You got to fix it in terms of the weight.
Yeah.
But what I'm trying to say here is that, yes, we have to look after ourselves and have our own standard, gold or silver standard. But I want to live in the world where most people are happy and doing well, because I grew up in Brazil, and I know, I was on the right side of things in Brazil, because, my dad was in shipping, and he earned dollars, but I could see the poverty. It's just like, you go out to a restaurant, you come out, and there are people begging everywhere, and you don't that's what inflation does, a world of inflation. And we're starting to see that more and more in the UK and everywhere around Western Europe.
It leads to a very divided society with the haves and the have-nots, people that have the ability to accumulate precious metals, and so many who don't. And yeah, I totally agree.
You know what's nuts? Is that's when you're in a bubble. Recently, people we're talking, people are going to start getting paid in Bitcoin. Companies starting to pay in Bitcoin. Man, they should have been talking about getting paid in gold instead.
And I think if there's a move towards that, that could force governments to go on a gold standard, you see, because if all the major unions are asking for it, I think in the late 70s, I think it was one of the actresses, forgot her name, she wanted to get paid in Krugerrands. I think it was Bette Midler or someone like that.
Well, that would suit me for sure. Pay me in Krugerrands. I don't want your paper, thank you very much. And of course, the alternative, and what's quite likely in this digital world that we're living in, is that we have a government-backed digital currency, aka the digital pound, the digital dollar, and that backed by something tangible. And we can see perhaps a move towards that in Eastern economies, China and Russia and places like that. Huge amounts of gold, and I think we know they've been buying and hoarding gold for a long time, and I don't think China's been selling its mined gold anywhere for a very long time. So goodness knows how much they have. But you can imagine what might happen if they were to announce a digital yuan backed with gold, with something real. Anything like that. I mean, I think this next sort of 5 to 10 years is going to provide a lot of shocks and a lot of turmoil, and that kind of thing is, well, in my view, quite likely, actually.
Well, I think in the West, the only way for people to trust a government with a gold standard, because you have to trust them, is I don't see the guys in power now doing it. So there'd have to be a complete revolution and the change of regime in the West. And even then, if they come out, oh, we're going to give you a gold standard, you have to tell them, you got to, allow us to go to the bank and redeem it at a fixed rate for gold. And we want a bimetallic system where, the change is silver. And some people might think, oh, it's going back, you're like a dinosaur, with everything's digital. But look what, the digital world has brought us. We're in this situation now. So
yeah, I think that's and that kind of thing is likely to gain popularity. As I say, there are companies out there who are engaging with employers and have large employers on their books who are paying, at this moment in time, or at least giving the choice to their employees whether to be paid in digital gold and silver, and allowing that gold and silver to be entirely redeemable physically at very, very low cost. So that kind of system and companies and organizations are already in existence. And I think that is something that's very likely to grow over the next 5 to 10 years as we see more sort of inflation and monetary mayhem. So that is maybe something of a trend and a snowball that's likely to grow.
I think in the past, like hundreds of years ago, the reason governments got involved in the minting of gold and silver is because you had a lot of charlatans, and people cheating. So government maybe was a bit more honest back then, though. So they said, "Oh, we'll do something. We'll."
Oh, he froze. He freezes sometimes. Yeah, I thought it was me.
Yeah, I don't. No, so
you're back again.
They used to. So you could take your gold and silver to the mint, and they would mint it for you. And people who, when you exchange that with other people, if it had the government stamp, they would know that it's good. But government has gone so far into disrepute now that what you're saying there could be an option, some kind of private currency backed by real gold and silver, which you can ask for redemption.
Well, there's one thing I've learned, is like, because my father's Lebanese and I see what's happening there. People will find another, like their Lebanese pounds getting depreciated and they can't even take out more than $50 a week. Like it's crazy stuff over there. Where people they're paying cash in US dollars, and so if you put too much of a constraint on people, too much taxes, they'll go. The humans, we're pretty flexible. We'll find a system which. You can't tax people too much because or else they'll just won't pay them. And so you can't, it's like even like with your kids, guys, you see it, right? If you're too tight with your kids, they're just going to escape the window and go out anyways. So I think human nature is going to stabilize all that, even our fears. If stuff goes too much in an extreme, then humans are going to try to find a way to create an equilibrium somewhere. I hope.
Well, that's maybe an optimistic note to end on. I know we've been chatting for an hour or so though, so it's probably a good point to draw the conversation to a close. It's been really fascinating chatting to you, Mario. It's always great to have you on the show, your expertise and experience are a real boost, and hopefully people watch this and learn a lot.
Thank you for having me on, and yeah, anytime. And I guess you
frozen in his prime. There you go. You're back again.
And no, this never happens. I don't know what's going on, but anyway, it would be nice to have you guys on as well, because even though I do technical analysis, all the stuff that you do is really interesting, and you look at things that most people don't.
Yeah, we got to keep sharing, because we're like scientists. Like why start from zero? If you get somebody sparks your something and you're able to meld that with stuff you've been working on, and then you share that, it's like it's work and value for everybody.
Yeah, that's why social media is really good, because you'll pick up on people's ideas, people's work, and suddenly, as Patrick says, that sets you on a track and on a direction, and you start unearthing new stuff. It's really good to look under the bonnet and look under the hood and find out what's actually going on underneath these charts, and find correlations and relationships that kind of give this weight of evidence, this kind of help to build a big jigsaw puzzle of what the heck is going on now and where we're going over the next 5 to 10 years. It's just putting all the pieces together and getting the picture right. It's a fascinating thing that we all do. So I hope people enjoy this podcast, enjoy this video, get something from it, and like and subscribe and all that kind of thing. And we'll do more.
Go follow. We're going to put the links for Mario's stuff in the description. Go follow him on Twitter. He should have at least 4 times as many followers that he has on Twitter, and at least 10 times more on his YouTube channel. Guys, he's always there doing cool stuff. So let's catch up soon, Mario.
Great. Thank you very much.
All right. Thank you. Thank you, sir. Bye, Kev.
Cheers, Mario. Bye, Pat.